Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 27th of April. I'm Daniel Lam, your host for the podcast. We've been advocating investors to rotate into fixed income as part of our SAFE strategy. Now, US 10-year yield has dropped by 70 bips over the last 7 months. Is it unattractive to buy fixed income now? Should investors be upping their exposure in high-yield bonds in order to get higher yield levels? Well, in our view, you got to put things into perspective. So, compared to yields of sub 1% during the policy loosening era, we see the current nominal yield of around 3.6% from global bonds as attractive to add to bonds. We prefer high quality over high yield bonds as their defensive nature should provide shelter in a backdrop of rising recession risk. Now, we're not convinced that the risk-adjusted return for high yield bonds is attractive, despite the 9% yield on offer, based on the following reasons. So first of all, the yield premium for high-yield bonds is hovering around its long-term average, which is still too tight to price a surging recession risk in our view. Secondly, high-yield bond issuers have weaker credit fundamentals and are vulnerable to an economic slowdown. And finally, we believe the Fed is approaching the end of its rate hike cycle. So until the Fed pivots, we're expecting investment-grade bonds to outperform their high-yield counterparts. Now, the other area of focus is Asian US dollar bonds. So China has started the year on a solid note, with both Q1 GDP and credit growth coming in stronger than expected. Now, although better growth prospects may lead to higher yields in China, we see headwinds such as disinflationary concerns emerging after lower CPI and PPI data in March, heightened global recessionary concerns that could weigh on the China's recovery, and thirdly, the monetary policy remaining intact as the PBOC maintains the one-year medium-term lending facility rate at 2.75% for the 8th consecutive month. So, overall, it's not too late to rotate into high-quality fixed income and Asian dollar bonds, particularly due to the impending US recession. Investors should continue to be positioning their portfolio in a defensive manner. That is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.